Staying with the markets. Gary Dugan's with us, Chief Executive of the Global CIO Office here in Dubai. Morning, Gary.
Good morning.
We've asked you to come in to look back at the first half of the year. It's the 1st of July, and to get at your crystal ball and look forward. But first of all, let's start with a review of the year. Turbulent US stocks, first of all, but they are at a record high yesterday on Wall Street. What's your verdict?
I think if you listen to the rhetoric, you would have thought it's an extremely strong first half. But the market was up only 5%. And it's had the headwind, although there's been some good news, of course, but the headwind of a very high valuation. And also the tech sector has had its good days, but it's also had its bad days. So there hasn't been the same support momentum. So the action really has been in the rest of the world.
Okay, a final quick word, though, on the US, because it is the world's biggest stock market, of course, 5% higher. The Mag 7 haven't all done well, have they? Apple in particular has had its challenges.
It has, and sometimes I think people forget that Apple is a technology company, but it's also a retail company. And if you combine those two valuations and look at the underlying growth rates, you can't get the kind of same excitement as you do from Nvidia. So it may be called a tech stock, but I'd say it's 50-50 with being a retail company.
So in terms of the portfolios that you don't manage but advise on, and their US portfolios, when they say to you, okay, Gary, S&P 500 at a record high yesterday, valuations are high by historic standards. What should I do? Should I buy, sell, or hold American stocks? What's the conversation you have with them?
Well, this time I think we would say, if you forced it buy or sell, I think you'd be a buyer. Largely because we do still think that, there's going to be discussions and chatter around cuts in interest rates. There will be, I think, concerns about growth into the second half of the year. But the tech sector you still don't want to bet against. I might be poo-pooing a little bit Apple, but there are still a lot of good companies there with strong revenue growth. And you can't really get those same stories elsewhere in the world.
So how do we play it? Do we buy an S&P 500 tracker fund? Do we stock pick, buy some Nvidia, short a bit of Apple, or whatever it may be? Do we buy funds focused on AI or the tech sector? What kind of strategies are people talking about?
I think you keep it simple. I wouldn't just hold S&P 500, but let's just say that's not 100% of your portfolio. It's probably something like 60%. The other would be 40% into technology. If you think you're good at it, then maybe you do some stock picking. Otherwise, you just do use a NASDAQ ETF.
Okay. The value is not in America. I was looking at the price-earnings ratios of various stock markets. America is the most expensive in the world, as well as the biggest and most expensive, closely followed by India. Europe's cheaper. Dubai is cheaper still. But where are you seeing value?
We still see the value in Asia in broad terms. I do think that China can still give us a good second half performance. And there is still an opportunity in Europe. Although some of the stocks, like a real standard bank stock such as Deutsche are up 60% since the beginning of the year. But in terms of global valuations, these companies are still relatively cheap. So I think a weight of money will be going into Europe and Asia. And I think the outlier for me will be a good performance from Asia, and particularly from China in the second half.
And again, I was looking at the valuations in China versus India. India is so much more expensive, like a valuation multiple of 25. China's about 10.
It's confidence. And people are not confident about what's going on in China. It isn't so transparent. But I think you are going to see greater transparency. I think you are going to see a relatively better momentum and stability from that country. And there are some, we can talk about modest returns year to date, but there are some mutual funds that invest in China are up nearly 40% year to date. So that means there's good stock picking opportunity.
Well, again, and if we're going to play the China market, what do we do? Do we buy just a tracker fund for the wider Chinese market? Do we pay a bit extra and actually pay for someone for an actively managed fund, whoever it may be, a Fidelity, a JP Morgan, doesn't matter?
Absolutely. You'd go for the active manager. Not every stock in China is going to have a great time. There are certain sectors well supported by the government and others that are not. So it's better to have the stock picking and to pay up. And I would use some of the China managers, not the international guys. You need people on the ground with a kind of really deep-seated analytical base that's on the ground hearing the good stories.
Okay. Do you have any names you can name?
There's a company called Full Goal in China.
Full Goal?
Fullgoal. It is one of the largest asset managers almost in the world, but people don't hear about it. And that's the story, and that's the story in China, undiscovered.
Okay, should we hear from the lawyers? Okay, we have recommendations. Here we go, guys. Earn your money.
And investments go down. Before putting your hard-earned money into any investment, Dubai Eye 103.8 advises you to always do your own background research. Ensure you're informed to navigate the market and any potential pitfalls.
Right, Gary, that'll keep us out of jail. Good stuff. We've got a couple of minutes left with you. 2 regions I want to ask you about. We'll get to the Middle East in a second. What about India, a country you know very well, but the stock market is very expensive?
Yeah, and people would have said that for the last 2 decades, that this market is always a double-digit P multiple towards 20 times earnings. I think at this stage of its development, you've got to say, where's the next piece of good news going to come from? And it probably is a pause here. We've already had the rate cuts, and the RBI has said, well, listen, I'm not going to give you too much more in the near term. I think I've given you something to last you, in a sense, for the next 6 months. But the earnings revisions are still generally positive. If you look through the breadth of the market, there are people still finding buying opportunities. And although you're paying up for growth. And this is one of the fastest growing economies, both in real GDP, so the number of units of something, plus a bit of inflation. So you're looking at consistent GDP growth in aggregate of somewhere around about 10%. You don't get that in the West. And therefore, you will pay up for that growth, but you'll have to be a patient investor.
Again, worth paying for an active manager?
Absolutely, yes. There's sectors that are down and others which are on the up, and you need to be in that mix. You can't just sit there with a tracker.
Right, let's finish in our home market. Dubai up 10% so far this year. It's had a good year, but still one of the world's cheapest stock markets in terms of price earnings valuations. What's your strategy here?
I think you've still got to be very positive. There is money coming out of places like the United States for a variety of reasons that goes seeking opportunities around the world. Somewhere like Dubai gives you a low valuation, clearly close to a 10p multiple, and a good dividend yield. And dividend income, people are searching for. In the US, you get nothing at all, and a market like this. So this is popping up at everyone's screen, and people say it's too small, but then people say, well, I need to put this money to work. I'm going to try it. And that's what I think the Middle East will benefit from.
Again, fund manager, worth paying up for an active manager?
It is. The breadth of returns we've had in the Dubai markets year to date is enormous, 100% to minus 10. So it's better to have an active strategy.
20 seconds, what keeps you awake at night?
Donald Trump every morning. But, in reality, I am worried about the second half because we're going to see more inflation. We're going to see less growth in the world. And I just I hope it doesn't get exacerbated by further geopolitical strife. So let's pray for the good news, but it is going to be tougher.
Gary Dugan is the Chief Executive of the Global CIO Office based here in Dubai. Always good talking to you, Gary. Appreciate your time.
Thank you very much.